So it is Employment Friday, and this employment report is causing some consternation. So as usual, and with the slides, I'll go through fiscal policy, monetary policy, economic indicators, and market indicators, and a little bit on innovation interspersed throughout. But I'll start by summarizing that, this employment report is jarring investors. Because it was much weaker than expected, mostly because of downward revisions to previous months, significant downward revisions. And so fears of recession are starting to surface. And I just want to remind everyone that we have been using this phrase rolling recession for the last 3 years. And I think as we get into the chart, you'll see what I mean. Anticipating that we would get this last leg, especially with the uncertainties around trade and tariffs, tax policy, and regulation or deregulation when it would take place. A lot of those are clearing up right now. And one of the big variables that many people are wondering about now is interest rates. This week, Chairman Powell sounded very hawkish. I think he didn't appreciate being featured along with President Trump at a construction site. So there may have been something else going on there, because the data as it is evolving here is certainly moving in a direction that would lead the Fed to ease. And of course, for the first time since 1993, there were 2 dissents on the Fed board this time around. And that suggests that we probably are going to see interest rate cuts in the future. I think the odds for a rate cut in September are up to 88%, and a 50 basis point rate cut, maybe they're up to 25% or so. We think that will resolve positively as well. That's the one uncertainty. And the reason this matters is, if people think rates are going to come down, then they're going to wait and see how low they go before they take major actions or make big purchases. So getting back to some kind of equilibrium is going to be important. And that is, we think, the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession, maybe starting with a rolling recovery, but gathering momentum. And we think by midterm elections next year, clearly on the up and up, with big upside surprises in real growth, productivity, and downside surprises on inflation. So that would be another positive because of productivity. We will start with fiscal policy. Now, what's very interesting is, year to date, the deficit as a percent of GDP has shrunk from roughly 7.3% to 6.2%. And as we add up all of the tariffs now, they're annualizing, it looks like, at $450 billion per year. So that would take us to the X you see here. I think that's roughly a 4.7% deficit. So we know that's going to happen. And the green line is 3%, which is Treasury Secretary Bessent's objective for 2028, the end of President Trump's term. Well, the 4.7% assumes no growth. And we do think growth will be slow until some of the uncertainties I mentioned are out of the way, but will pick up momentum. And we would not be surprised by the end of 26 to see this metric, deficit as a percent of GDP, at 3%, so 2 years ahead of schedule. So the bond market should appreciate that. And I do think investors, it will be a positive backdrop for equity investors as well. Now, I want to point out something in the tax package, the one big beautiful bill package. Some of these are pretty startling changes. In other words, they've never happened before. For example, structures, being able to expense structures in year one has never happened before. And it is now in place as President Trump and team are trying to attract more manufacturing back to the United States. It will be a little bit different from the manufacturing that left the United States, and with it jobs is going to be much more highly automated, but it will be here in the United States. But you can see these other three categories as well. Equipment we have seen in the Reagan Revolution. We had this kind of expensing on equipment, but not on the other two categories that you see here, and certainly not permanent. And that's what we think is so interesting. Roughly, I would say 75% of these tax changes, or 75% of capital spending, is going to enjoy permanent expensing. And that has never happened before. So this administration does mean business in terms of attracting manufacturing back to the United States. And we think this is going to be a very good thing. And we think the productivity associated with it is going to be astonishing, thanks to all of the automation and AI that is exploding on the scene today, now that the costs associated with both of them are dropping so quickly. So it's happening at a very good time. And so I've presented this chart before. The federal corporate income tax, while the explicit tax remains at 21%, incorporating the expensing that I just described will take the tax rate, the U.S. corporate tax rate, down to the 12 to 14% range. And the 12.5% range is significant because in the day, the Celtic Tiger, Ireland, began to attract a tremendous amount of manufacturing activity with its 12.5% tax rate. And now we are down at that level effectively. We also know that the CPI, which is depicted in the green here, faces some tough comparisons. So I think we have two more tough comparisons at the 0 and 0.1% rate for the next couple of months. So the inflation rate could stabilize here, and maybe that's what Powell was responding to, just knowing that the optics aren't going to look great on inflation, meaning continued progress. But if we're right, that will be it. Then we're off to another leg down in inflation towards the 2% and actually below the 2% range if we are right. Now, of course, we have been expecting much lower inflation for quite some time. Tariffs are complicating the situation perhaps a bit right now. the Fed jacked rates up in 22, so it's been 3 years that a lot of rubber bands are stretching, particularly in the housing and capital spending markets. The housing needs lower rates and or lower prices, and we are starting to see lower prices moving affordability up slightly. I think lower interest rates will really get it going in the next 6 months. And capital spending, now we have certainty with this tax package, and I think those two sectors are very high multiplier sectors. In other words, a dollar spent on housing causes all other kinds of spending to take place. When you move into a new home, you're buying lots of stuff. And the same with capital spending, lots of follow on from $1 spent on capital expenditures. So we do think the Fed's too tight. This chart is reinforcing it. We're starting to see a little progress. We've seen a relapse, and we do think it might mean that in September we'll see a 50 basis point cut, and perhaps for the rest of the year, 75 basis points when all is said and done, especially now that employment is showing such weakness.